Hey folks, what's going on? It's Grady here, and I'm back on the charts. Um, this is just one of those things that you really have to do every day, or as often as possible, in order to keep yourself up to date on everything that's going on in the markets and everything that's going on um, in your own head, to help you keep your um, pace, keep your timing with the market. Um, it's often a good thing to, in my opinion, or and as well as I've been told. Excuse me. It's a good thing to follow the market so that as the market develops over the evening, over the AM session, PM session, and the London session, to stay up with the market. Stay, because sometimes what you'll find is that because you've been tracking and you've been measuring throughout the night, that by the time the morning comes, or throughout the evening, by the time the morning comes, then you are still in sync with the phases of price action. So today we had news, and the news that we had today was balance of trade ISM, and then tomorrow we'll have non-farm payroll about 6:30 in the morning, and then we'll have the unemployment rate followed by a speech by the Fed chair Jerome Powell, and then that'll close our week out. And again, excuse me. Um, let's see here. Let's see here. Filter. No, not filter. Seems I'm frozen here and I'm not quite sure why. No, there I am. Um, right. So, well, without further ado, I'm just going to go ahead and get to work. And that's basically all I can do at this point. I'm going to go ahead and take a look at the market, and we're going to see what the market has to offer us here. All right. It's been a long day, so I'm a bit tired. So I'm just going to go ahead and keep going with, I guess, pick up kind of where I left off. Excuse me. Kind of where we left off earlier today in the market. So earlier today, excuse me, earlier today, I we started off the market here as we opened after a long run down, and I'll go to the 1 hour chart, and I think going from a higher time frame to a lower time frame may very well help. Matter of fact, we'll just start with the daily chart. So the market dropped. Wait, this is Monday, Tuesday, Wednesday. As the market closed on Wednesday, we ran up to this 4 hour imbalance that I had set here for several days. It's actually formed here back on Friday, March the 7th. I mean, Friday, sorry, Friday, March the 7th. And that 4 hour fair value gap stretched, so 4 hour imbalance stretched forward, right? If you pull it forward in time, this is what we see here. So the market respected the consequent encroachment of that gap multiple days in a row. Here on Monday, March 17th, we see that price ran to the high of the imbalance, but then closed and the discount below consequent encroachment here, right? Then Tuesday, we opened and we ran near consequent encroachment again. We failed to take it and then we dropped. Okay, so what we dropped down inside of this down closed candle with the low wick is just below the opening price of the closing price of this down close candle on the daily chart. We rose a little bit from that point and closed. We opened right off of that close, dropped down into the wick of this prior candle, inside of the body of this candle, and then we rose with our high being just shy of the high of that 4 hour fair value gap. But then we dropped out of it and we closed. So all this time, all this time I had been watching this fair value gap or watching this imbalance to see how price would react in this range. So price runs near the high of the imbalance of this fair value of this sorry, this I call it a fair value gap, but it was a volume imbalance. And so I'll change that text. I have it as a fair value gap. And had we retreated from that point, it would have been, I guess you would call it a fair value gap, but I'm gonna call it a VI. It's a volume imbalance on the 4 hour. And so we trade into this volume imbalance on the 4 hour chart, and then we reject. And then we close lower. The next day, basically trade sideways. We trade immediately off the close of that price. We drop well to the downside, but this candle is an inside candle, so it never goes above the high of this candle, and it never goes below the low of this candle. The next day, this candle opens because we close here. We open right off of the closing price of the prior day. Maybe I should zoom in just a little bit. Hopefully that'll be a little bit clearer as to what I'm trying to describe. Now in retrospect, I'm thinking maybe it'd be more helpful. So now we open right off of the low of this close. So we close here at 19,895 flat. We open just a little bit higher at 19,898 flat. So we open just a little bit higher with a very narrow gap up. Price then proceeds to go much, much lower. We take out the low of the prior day. We take out the low of the day before that, and we just barely slide right below the low of this down close candle. We reject that aggressively, and we rise. Price rises um, in the same day above the opening price of that candle, and then we close out roughly flat of the high. So the high and the close are roughly flat, and that is Friday, March the 21st. We gap up precipitously over the weekend, opening just below consequent encroachment of this volume imbalance. Now, as we open right below the consequent encroachment of this volume imbalance, my thought process was at that time that we should reject and go lower. However, on the daily gap, this is the daily gap. On the daily gap, we actually have I have volume imbalance here, but we actually have this large range of price where there's almost no, excuse me, there are almost no overlapping bodies throughout this entire range. So there's a huge gap in price here, and we rise all the way to this level. Now we'll take a look at that in just a little bit, but once we get to this level, I'm sorry, price rises to this imbalance. This is also an area that I was looking for a rejection. We close here, which technically was a rejection. We open off that level, drop just a little bit more, rise, close, and then on Wednesday we begin a descent. So let's go ahead and we'll move forward because that's a sore point for me. Yeah, it's a sore point for me. I'll just leave it at that because I'll open some old wounds. So then price, we'll return to that in just a second. Then we'll return to it in just a second. There'll be plenty more wounds to be had. So price drops right back down. The low of this candle is roughly even with the opening price of the first up close candle just prior to the consequent encroachment of this volume imbalance on the 4 hour chart. We place a wick and then we close above the consequent encroachment of that range. Overnight, between this Wednesday and this Thursday, we gap down, and as price opens, we rise higher to a breaker that was in the lower half of this down close candle. We touch off that level and then we proceed a little bit lower. It wasn't a massive fall. It was much more consolidation, sideways price action. It was a decent range. Um, and when we get to the lower time frames, we'll take a look at it and we'll see it. The next day, however, price opens, and my anticipation was maybe a rally to some of this area where we had gapped here, but we did not attack that gap there, as we can see later, right? I'll destroy that, and then I'll take this level off the opening price of this down close candle and pull it forward inside that volume imbalance. And we'll see just a moment how yesterday's price action, how we intersect that level on yesterday's price action. So that very next day we opened up. It was a very sweet open into London session, into a small gap at the high in London session of the pre-market, and then we just began to descend. And there was really no way to get involved at that point. Um, if you saw one of my previous videos, these are the days, these days, this run up, this run down, this run down, this run up, and then this run down. On all of those occasions, I was very aware of where price could trade to. And once it got to those points, either I was too impatient or I was too aggressive. Same thing, practically same thing. Too impatient, too aggressive. I wanted to get involved. I wanted to participate. And instead of waiting for price to come to me and to deliver properly, I was trying to get because it was calm down. See, calm down. Because price was moving so freely in both directions. There were many opportunities. However, that did not mean that price was um being measured, being very conservative in the way that it delivered. It could leave open a gap, and then could split the difference in the gap. I would go for consequent encroachment. Price would run that. When I looked later, the gap was much more than the risk I was prepared to take, and so the risk was much greater, and I paid the price literally. All right, so where were we? So price breaks down. So this is Monday. This is Tuesday. This is Wednesday. This is Thursday. Now, Wednesday, April 2nd, is Liberation Day. This is the day that the global tariffs imposed um, by the president, took effect just prior to Friday, which is the day that we'll have non-farm payroll. So this entire week is an extremely volatile week. Price, range, volatility are all through the roof because we have stacked on top of each other some of the most impactful, um, high level, as they would say, orange folder news that you could possibly have. So Monday and Tuesday we prepared for the news to come out, and we had a very deep dive and rally in the same day, which a lot of people, they were screaming, yeah, they're the tariff, yeah, yeah, the tariff. So the price is diving, and then it rallies in the same day. Very good opportunities, um, and as well as Tuesday. Tuesday we had much the same type of price action, but as we can see, looking at the lengths of the candles on Tuesday, that it was a very moderate day. It wasn't anything too wild. It was what you would hope to see in a trading day: a good open, a good low, a good high, a good close, and it was fairly compact, which means that between the meat of the day was in the body of the candle. So yesterday, I believe that was yesterday. Yes, yesterday, the market moved. I'll measure this because this is the type of stuff that I'll have to laugh at. Overall, that says 3,830 ticks. That was over $900. And then we gapped. That's all I want to say about that. That's all I want to say about that. Because if you can understand that if you can catch 1/10 of that, you have a very good trading day to capture a tenth of that. But in that total day, there was an opportunity if you were clever enough or alert enough or astute enough, you would be able to. Some people probably could, unlike myself, and calm down, buddy. This is entertainment. This is entertainment. Whew. Okay, but let me get serious. Um, there were some excellent opportunities to get involved in the market and to do very well. For those who are ready, they corrected their year yesterday. So we gap open today, and as we can see between the low and the close and the opening price today, whew, excuse me, between the low and the opening price today, price opens, we run higher, we come back to the opening price, and then we drop lower, which I think we all anticipated, but we've had very difficult times um, predicting or anticipating prices' response to news. Sometimes on great news, the market would tank. Sometimes on terrible news, the market would rally. Um, and so today we just we wanted to feel out what was going on. In my earlier recording, I did not take any trades today because I was in preparation for non-farm payroll tomorrow, and I did not want to incur so much drawdown that by Monday I would not be able to participate in trading. I wanted to really um, save my powder, let the market just do whatever it is going to do. I know that there could be some huge opportunities, but one thing that I do know is that being overly emotionally charged and overly emotional about the market is not a good way to trade at all. The only thing that it seems to do for me personally is it winds me up so much that when I want to make my entry, I'm practically paralyzed, right? Not because I'm overly analyzed, it's because once I become so clear as to what I know I want to do, I don't do anything. I'm working on it. I'm working on it. It's trade psychology. I'm working on it. It's trade psychology. And hopefully a month from now, we can look back at this and I can say, yeah, I still experience that. However, I have mechanisms and I have strategy in place for that. And I said months, not years. And if you decided to trade, then you would start to look at yourself and look at your um, trading in much the same way. That when you can identify the issue, then you can begin to put in place strategies and structure that not work against you, that work with you. So, no example right now. Let's just move forward with the data trade. I've been sitting here looking at this thing for like 18 minutes. And I say these types of things because, I was really talking my family's ear off about some of this stuff and they didn't want to hear it anymore. So I'm just gonna talk you guys ear off. So this is what I wanted to take a look at and just narrow it down to today's price action. Um, so this is where we started. And I think that if we go back and look where we started, it might help us a little bit. This run up and turn over here, I wanted to conceive of that. I wanted to impose on this area of price, this entire area of price. I wanted to think about everything inside of this circle as a balanced price range. Now, what that means is that because we've moved up and moved down in such a parallel way, the price would not return to this area. Um, so I was never thinking of price coming back to this area. If you watch ICT's video that he put out several days ago, let me see if I can pull that up real quick. ICT put out a video several days ago, and I just want to bring it up on the screen really. And this is where he points this out to us, and that video is right. 6 months ago. Nope. Videos. Come on, ICT, what you got for us? The 2025 lecture series NQ Futures Review for 4/1/2025. No, nope, nope, nope. You can play. I don't want to hear the. I don't want to hear the. And so this is the video. Um, you guys read this very careful. Forex risk disclosure, government required risk disclaimer, and disclosure statement. I think I'm gonna find one of these and download it, put it up too. And the only reason I want to do that is because I want you to guys to understand how serious this really is, and this is not to be taken lightly. That's why I said that what I do is I entertain. However, ICT, the inner circle trader, here's his page here. He has been teaching trading for many years, and his lecture series are up. And so the video from 2020, the uh, lecture series 2025, April 1st, he talks about how this runs up to this balanced price range, breaks down and falls, right? But what I was looking at in the pre-market was I was also looking at this area here. Yep, I was. I really, really was. I'll go to the 15-minute chart. So I don't see my London session. I don't see where my London session mark is here. And I think that's a little bit odd, but that's okay. Because London session should be right here. And it should look like this. Let's see, 5 a.m. I think I deleted it when I was cleaning up the chart earlier so I could see clearly. To here, there, and we'll lock it there. And then we'll just call that London session, and then we'll lock it down. Okay, so the market opens here, right down here, and then it begins to rally. I was looking for some sort of a first presentation fair value gap in here, but then we ran right up here to this balanced price range. On a higher time frame, it just looks like two overlapping wicks, just like this, right? It looks exactly like that, these two overlapping wick areas. But as you zoom in, then we'll see that there's a bullish order block right here. So we trade directly to the bearish order block. We trade to the bearish order block. We turn over, we drop down, we trade right back up toward the low. We end with this candle. We fall, we rise into this imbalance right here. Pull that forward. We rise into this imbalance right here, and then we turn over from that point and we move lower. And the thing that I was saying about this was, um, I was preparing for a run above London session and to fail. And I believe ICT describes this, not this particular movement. Normally, if we'll see a movement in the pre-market above London session, it's practically always a Judas swing. And why am I starting so far back? I'm starting so far back because the repetition of price action and the repetition of price being called to certain pools of liquidity or certain points of interest, they happen in a repetitive way, but they're not exactly identical. Um they're how is it put? They're not twins, but they sometimes rhymes or something like that. I don't know. Hey. Just trying to speak here. Okay. Um. So, so what I'm looking for now is I'm looking to refresh and remind myself about the consistency and the repetition of price. How we're trading to gaps, we're trading to order blocks. Sometimes we're trading to consequent encroachment. Sometimes we're trading all the way through, and then we're looking for the body to close, right? And it will help us going forward because lower time frame candle price action is echoed as an echo of larger time frame price action. So the method in which price trades is exactly the same, um, to a certain degree. And but also it is the word is there a word confluential? If there isn't, I would like to create the word. They're also clumfu. They're also confluential, meaning the high on the hour is also the high on the 15, is also the high on the 5, is also the high on the 1. It's the same number is the high on all time frames. It sounds obvious, but while you're trading, and we'll see later on today exactly what we're talking about. Actually, this next few moments we'll see it. Okay. So now this high, remember that 4 hour volume imbalance? Excuse me. Whoa. Remember the 4 hour volume imbalance. Here we see at the close yesterday, skipping a few days, right? Because price after we hit this balanced price range, we just trade down into to this gap, this fair value gap. Then we drop lower. London session the next day occurs. We practically repeat a very similar price action. All we do is we run right up into London session, we hit the imbalance, and then we collapse. Yes, I watched it happen. I did nothing. Even after the previous day, I did nothing to get involved. Even after I saw the exact same thing happen the previous. Never mind. Never mind. So then we fall in, and we drop low here, London session. And the reason, and you would think that I'd be looking from um New York to New York, right? No, I look at New York, London to London, because I believe that the London session price action is the um anchor of the price action. Like in a race, however the anchor performs is however the entire team is going to perform. So if you're running and you're passing the baton, and the anchor, the last runner decides to sit the race out, it doesn't matter what anybody else did. That's what we start. That's where we start. So London, I believe, it starts price action for the day. And then there's a lot of stuff, as you can hear me describe it. There are a lot of concepts and things um that I am tumbling, I tumble through, and attempt to utilize, that many people would say, well, where's your um VWAP, right? And I don't use the VWAP. And I believe the VWAP is a very interesting tool to use, except it doesn't it doesn't explain to me or show me where price starts. And I'll get to that a little bit further. So from London, we drop down here, right? And these prices all trade just shy of, when I say shy, I mean just over consequent encroachment of London. Then we run out liquidity below all of these levels. Once that liquidity is taken, we consolidate just a little bit through these 15-minute candles. The lows of these candles, I lost a lot of money trading through here, because the 15-minute consolidation gives me more of the signals that I like to see than almost any other consolidation. Maybe the 1 hour consolidation is worse. If when you have three 1 hour candles that have even closes, the first hour closes, the second hour opens, and then the next hour closes and then rises right back to the open and close of the first two hour candles. All of those entry and exit signals all overlap. Very confusing. Like, those are the days I just need to sit out. So this day was a very tight range consolidation to the upside. All right. But once we get here, we also move sideways the next day. Now, because we've moved sideways here in the post market and the pre market, in the Asian session and the London session, because we moved sideways, I was anticipating movement the next couple of days. So what we got here is we had a gap up here on this Tuesday in London, which is so unusual. But then price drops down to that imbalance. We rise higher. We take liquidity out above these two relative equal highs, and then we drop down below London session. So we've traded above London and below London. Then we pop right inside of this imbalance. Now the thing is this looks as if it should just send price straight down, right? It looks as if it should just send price straight down, but it doesn't. And this is one of those times where I really just have to understand that this consolidation that was in this narrow range is not over. It's just expanding, right? So the consolidation was in a narrow range, and then it just begins to open to a wider range. Okay. So The consolidation begins to expand. And how does it expand? By taking out the low of this entire range down into this imbalance, which is something that you have to keep your eye on. And it seems like, oh, there's just so many imbalances to keep track of. It is on the 15th. And I'll show you just something in just a second. Then we run higher. We drop back down into this down close candle, which is a bullish order block. From there, we pop up and then we take out the prior day high. News comes out. Price just lethargically but consistently sells off all the way down, all through London in a perfect little arc. This sells all the way up, all the way up, all the way down. Down. Till we get here, I'll take this little red line and I'll pull this all the way back. And then I'll delete this gap. Yes, I'll delete that gap. When this is the high of that gap. This level trades just to consequent encroachment, wicks into the discount, moves higher. This level, discount level trades into this level, moves higher. This level drops all the way down in to here. Boom, boom, boom. I want to show you something that I have never done this. I don't know what's going to happen here, but I bet you if I go from the low here and I'll put OTE on this level should hit 87. And I've never done this before. I've never done this before. I've never done this before. It's a weird thing I noticed on the 5 second chart one day, and it was just recently. It's a swing high. It's a but it's a swing high, but it's a low with a lower low and a higher low. It's crazy, right? And I'm sure ICT has come across this several, and hundreds of times because I'm not oh wait, yes I am. I almost messed up. Almost messed up. Guys, I got something brand new for you. Not even ICT knows. So it's a swing high. It's a low, higher low, and a lower low. I almost messed up and gave ICT credit for his work. Oh, okay. Sorry. Almost messed up, gave him credit for his work. Okay. All right. So yeah, and I noticed that the other day. It's a swing high. And this level lines up with 79% retracement. And then there's a zero level. And I think on one of my fibs, I extended beyond this level to try to grade in advance to see where price would go. Now, my only problem is I'm a little slow. I'm a little slow because all of the price levels and confluences, well, I said I'm slow. This happened 24 hours. It took 24 hours for it to happen, but it's just one of those things. Yeah, I got something guys. I got something today that even ICT doesn't know. Let's try it again. Let's try it again. This will be for them. Hey guys and girls, check this out. I got something for you even ICT doesn't know. Check this out. And I don't know. I don't know. I'm working on it. I'm working. And I know it's like, swing lows, swing highs, optimal trade, fair value gaps. I know all of those words, but I have to come up with new words so that people won't think that I learned this from ICT. Okay. I'm gonna be famous. All right. So, and it's like I said, this is something I just noticed the other day because I often see it on the higher time frame as this sort of I don't know how to describe it. But once it happens, and I think this is a market maker, something or other. He has a name for it. I'm telling you, I gotta come up with my own. God, I gotta come up with my own. And then it rises higher. We consolidate here. There's the 4 hour close of the 4 hour candle. We touch the close of the 4 hour bullish candle, which makes it a bullish order block, and then we rise higher to where? To the 4 hour volume imbalance. And if we look back, we remember that this line is connected to something on the 4 hour chart. I should have labeled it. I should have labeled it. Oh, yes. It's connected to the low of the bearish order block. Oh, that is the open um bear order. I didn't want to have to type all of that. Let's put this stuff in my mouth. So it just rises up to the opening price of the bearish order block, and with a fair amount of precision, the high of this candle is going to be 20,044.25, and this candle is 20,046. So, you know, it's in the wick of that candle. Forgive me, guys. I was wrong. It was almost there. It was almost that close. So when we ran this level, the market was already closed. So it runs that level, it touches that bearish order block, and then immediately gets away from it. And then we consolidate overnight, London session, and then we begin today's price action, which I covered earlier today. The thing that I recognize now is that in my pre-market preparation, all of these candles look the exact same early in the morning. Early in the morning, to me, all candles it's just blue and black, just blue and black. And I don't know if blue is going down or going up. And it's so weird. Sometimes I just study and I study and I study and I study, and then I come to the market in the morning and I do all of the markup that I wanted to do. That's supposed to give me this supreme clarity on as to how the market is going to perform. And then I'll sit here and I'll say, what am I looking at? When the market opened here. The market opened right down here. We had made this dip all the way down. The first thing that I was thinking was what? I missed that move, right? So the only other thing that I was thinking was that between the close yesterday and then today's open, we left this large gap, and that which would be the opening range gap. And which would be we left this large gap, which I've graded out here, which would be the opening range gap. And we in the London, well, obviously this is London. The only thing that we did, we never made it back to the 75% retracement of that gap. Okay. We retraced it in the Asian session, closed it out in London to retrade back into this level. But then we opened here and we made no attempt to return into this gap. So the only thing that I was thinking is, all right, balanced price range. We dropped down, we consolidated and touched every price that we could think of in this entire range, just going back and forth until we got back to the order block. Then we dropped. Okay. So now that we have this range in play, this reminds me of down closed candles of a large fair value gap where there's space above this high that we could run to, reprice to, maybe like the low of this candle or the low of this candle, touch, and then it'll send us much, much lower, right? Okay, so what if price doesn't do that? Well, we're not going to think about that now. What I would like to see is I would like to see how price finishes up in London session, and then we'll take a look at what happens for non-farm payroll tomorrow. Um, excuse me. We'll take the data from that, and then we'll just come back on Monday, tentatively. And we'll be very defensive on Monday because price could be extremely volatile, or it could be operating very sporadically, recklessly. It could be all over the place, right? It could be disorganized. We could be in a massive consolidation, just moving back and forth, trying to account for all of the distance that we've traveled in this last week. So, what we saw this morning, as I recounted, was my problem. My problem. My problem this morning was, if I go ahead and say Thursday, notes, notes for Thursday, journal entry, and then I will. Go and I'll grab Control Shift S. And then I'll come over here and I'll Control V. And I'll paste in the notes from today. And I'll just drop down right here. And let's see if I can activate this camera. Notes, deactivate, activate, fade. Mic check, mic check. Okay, I'm here. So the thing that I wanted to type in was what? Today, today, today. All right. Forgive my typing ability. Today, I focused on the lower time frame, right? And lost sight of the higher time frame GD arrays that would later serve 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 SCRVE as points of interest that would later serve as points of interest and uh, points of interest and what? Not draws on liquidity. Um, origin points, I guess what I'd say. Origin points for price to deliver, deliver, deliver uh to um origin point for price to deliver to hmm, larger pools of liquidity. And there's no you. There's no liquid without you. Liquidity. PD arrays. I think I'm gonna go ahead and I'm gonna put PD for the price delivery. And it should be double R, not double A. Lower. Today I focused on the lower time frame and lost sight of the higher time frame PD arrays that would later serve as points of interest and origin points for price to deliver to larger pools. To the larger pool of liquidity. No, not forward slash. Go ahead. Let's do that. And if you'll go back and watch the video that I posted on today, yeah, that was the issue. The issue was that when the market opened, I was so fixed. My mind was so fixed on the first presentation fair value gap, and I have good reason to. The first presentation gap had been really paying off for quite a period of time. However, I wasn't really tuned into this 15 million to this 15-minute chart. Come back over here and let's take a look at the 15-minute chart. And we'll see here on the 15-minute chart what I should have been looking at one more time. And this is the thing that we'll deal with again tomorrow. We'll deal with this again tomorrow. And very beautiful thing, very beautiful thing. I just want to do this, want to add this one more thing here. So I have this area marked out and I want to zoom in a little bit closer. So what happened was, we opened here. We opened here, and I'll mark that with my little marker point. We opened, I'm gonna say around in here somewhere, right? Where that red dot is. And then price rallied for, 15, 20, 30 minutes until just before the close of the hour. And so one of the things that I was struggling with was the 4 points to be concerned about between the switching of the hours. There are 4 points, and the 4 points are 9:50, the beginning of the macro. Um, it sounds ridiculous. I said 4 points, but I forgot the fourth point, just like this. But there's the beginning of the macro at 9:50. There's 10 o'clock, and then there's 10:10. Okay. Then there's the fourth point, and the fourth point is where's the macro delivered to? And those are the 4 points that I wanted to talk about. Why? Because just prior to price activating for the macro, where did it just come from and where did it go? Right? Then here, today's macro, as we open and we run to this high, the only thing we did is we did exactly what we did on several days ago, where we ran up to the bearish order block. We tapped the low of that bearish order block in the almost exact same fashion that we did, like we said, for the 4 hour volume imbalance. But today we crossed this imbalance. The prior up close candle hit consequent encroachment and stopped. The wick of this candle, which is one that normally takes me out of some of my best trades right past that, touches the order block, then closes below the mean threshold of this bearish order block. It taps this order block, respects this order block, closes it at its low. This next candle rises, never takes out the high wick of this order block. It trades into the wick of the order block just above the closing price, and then we fall. The third candle rises just above the low and just barely take this out. We don't even go past the mean threshold, which is probably the safest place on the chart to enter. And then we deliver for a few handles. Let me see how many, eh, how many petty handles we deliver. Oh, oh, I'm sorry. Oh, I'm sorry. That's like what two? That was 200. That was over 1,000 ticks right there off of that one move. Then later on, we rise to the low of that same bearish order block. We touched the low of that bearish order block. And let's see. Sorry. Let's see what we did with that. Let's see. We touched the low of that. We'll start here. Let's just say we were conservative. And then this is another 1,400 ticks to the downside. So you see why I get excited. You see why I get excited because when it's on, brother, it's on. When it's clicking like this, it is extremely intoxicating to imagine what it's going to be like when you stop letting greed get in the way, when you stop letting fear get in the way, when you stop letting impatience get in the way, when you stop over trading, when you stop over leveraging, when you formulate a real trading plan with a real trading strategy, and when you study, you never know what'll happen when you study all of ICT's material and then rebrand it and rename it and relabel it all for yourself like I'm trying to do. This gives you chills. Let's get back to work. But until then, I still have to call it same thing. Still have to I have to learn it first, then I'll change it. But then you guys, I'll have a full, we'll have a full course, a full Discord, you know. We'll get it all together. But you guys gotta just be patient. Um and for those you guys who just won't take the time to learn for yourself, I don't I, it's you know don't listen to all the haters who saying that I'm stealing his stuff. If you don't haven't learned it for yourself and you don't know what I'm taking and what I'm not taking, don't worry about it. Okay, and so that's it for today. The other thing that I was wanted to keep in mind was higher time frame the higher time frame highs. And that it struck me today more clearly than it had before that the higher time frame highs and those lower time frame runners and the lower time frame areas are the same place. Because I know that we're going to run the order blocks. I know that we're going to run inside gaps. I know these things. The gap here on the hour looks a little something like, you know what I don't want to do? I don't want to take that. I want to duplicate it. And I want to drag this to that area, pull this back, and I hope you guys can see this. But if you can't, sorry. Pull this forward. Boom. Okay, so on the hour, we don't close above consequent encroachment of that wick. We just barely, we don't even go into the premium high, right? We basically have placed a wick into a premium low, roughly, nearly, almost touch the low wick of hourly bearish order block, and then reject. This is the same one as we can see here that we ran right into this area on the 15 minute, and that's the 15-minute high. And we can see by the arrows the areas that we're running to here, here, here. Inside the wick of this down closed candle is the body of the bearish order block. So as you can see, in a few months or weeks, boys, a few months or weeks, either one or two things are going to happen. One or two things are going to happen. Number one, either I'm going to learn how to trade this properly. I'm going to be patient. I'm going to take it seriously. I'm going to trade this as a business. I'm going to keep my emotions relevant but in check. What I mean by that is I'm not trying to suppress. I'm not trying to be a robot. I'm trying to understand truly what this means. And then number two, once I get all of my psychology in alignment, and then I trade this and I follow the instructions, precept upon precept, line upon line, then I'll be able to rename all of this stuff, rebrand it. I have to come up with some really snazzy names, maybe some acronyms. Now, his stuff is ICT. I could call it G something, right? GAP. I have to come up with something really, 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 really solid. Um, but I'm gonna work on it, guys. I'm gonna work on it. Guys, I got something for you that even ICT doesn't know. I gotta work on it. Guys, I got something for you that even ICT doesn't know. I think I got this. Whew. Hopefully I won't be out there like them guys selling courses. If it's that bad, I just be being lazy. All right, well, that's it. Now, this isn't really how I would normally take notes. How I would normally take notes is definitely I'll have to pull up the daily chart. And I also look at daily gaps. This week's the gaps of this week have been so extreme. If I would grab the closing price from this candle and the opening price for this candle, and I would stretch it forward. And the date of this camera. The date of this camera is 4/3/25, and this is Wednesday to Thursday. I would do this, and I would call it a new day. Nope, that's wrong one. New day gap, and I would say WD for Wednesday, THUR Thursday, and then I would mark it out as Thursday is 040325, right? 040325. And I'll keep that date. But look at that range. This is unusual that we close here and we open there. These are the normal weekly gaps, right? Normal weekly gaps and normal weekly ranges. And normally I would only try to keep the most recent on the chart. The only issue that I have with that is that when we go through these larger time frame consolidations, we're still overlapping and to some degree respecting the body's consequent encroachment the highs, the lows of the um, the daily gaps and especially the weekly gaps. As we can see here, that imbalance that we were looking at yesterday, the only thing we did is we ran up to nearly the high of this weekly gap and ran almost exactly to what it seems to be a daily gap that we had there, respected that level, and then we rejected. And then it doesn't seem like we would, but even here, this daily gap here is where we closed and almost where we opened. We closed near the low, opened below it, and then we moved up above it. So a lot of these things I keep on a separate chart so that so I could keep track of. And then just like this one, we close here and we open here. And it is more along what you would expect from a normal daily gap. And I'll pull this forward and I'll type in um Thursday, Friday, 03, 05, 25. And this would be the gap for Friday, just recently formed a few moments ago when the market opened. And I am missing, no, this one is here. I think I'm missing this one, but it's such a narrow gap. I don't want to overlap it over the old one. That was also a very narrow gap. So there's that. And then here is the gap for this week that began just a few days ago. That doesn't seem right, does it? Is that today's weekly gap? Thursday, Monday, Thursday, Monday, Thursday, Monday. Yes, because I would need to be on the weekly chart for it to make sense. See? And there's the weekly chart. And then this is another thing that I refer to. Great. Let's see. Is this I have to make sure that's this actually on screen. And ICT says that people don't study his stuff like they should, and they really, really should study. They could come up with their own trading programs. They do. I mean, I'm sorry. They could make a lot of money trading. Honestly, trading psychology is the thing that really has affected me the most. And so when I jest like that and I joke, it's because it's gotten so hard for me sometimes that I think about it, right? Think about it. It's just like maybe I should just start telling people, what I know. Just not everything, just telling them like, oh, I know how to draw a Fibonacci, right? And you know, I've seen people do that. I've seen people do that. They'll tell you, hey, buy when the market is trending and just hold. Whatever direction, buy or sell when the market is trending, just hold. And they sell that type of information. So what do we have here? This is look, I'm getting started. This is my LS3 primary range. Ooh, let me tell you boys something. Tell you guys something ICT doesn't even know. This is the LS3 primary range. It's something I developed myself from my hours of studying the markets. So, okay, as you know, ICT tells us teaches us about grading the London session, right? And from the London session, the market could go certain numbers of standard deviations, one, two, three, four, around six normally in either direction from that standard deviation range of one single London session. One day, prior to the market open, I'm not sure what it was the night, whether it was the night before or the day of. I think I might chop this up into multiple videos, kind of breaking it up with a joke, with the still in ICT's material joke. But what was I saying? I've been on here an hour. Yeah, and this is normally how I spend my nights. So I decided to record it and post it. And then anybody who sits around and looks at charts for hours and hours and end, people can actually walk up to their office door, their bedroom door, whatever, and hear them talking. Hit the like button. If you see this video years from now and you've been trying to trade and you're talking to yourself out loud while you're studying your trade, hit that like button. just to let me know, yeah, I'm here in my office. I'm in my bedroom, my laptop with my tablet, and I'm sitting there. That level, this level, that looks like resistance. Okay, so where were we? Where were we? Here we are. Where were we? Okay, LS3. So what I started doing was, is I started noticing that there was a confluential line. Now, if you can find this lesson in ICT's mentorship. Put it in the description below. If you can find this lesson in ICT's anywhere in ICT's lesson where he says measure out 3 London sessions, put that particular lesson in there. Because if I forgot about it and I saw it and now it's coming from my subconscious and I'm just doing it now, I would love that to be the case. I would love that to be the case. But guys, I'm gonna show you something not even ICT knows. Um, let me get to it. I'm killing time here. I'm rambling now. Okay, so what am I saying? So I get to measure um and grade the range from the high to the low of the last 3 current London sessions, kind of as we have seen here. Sometimes all 3 of them are in a tight range. The most I've ever seen was 10 London sessions within this LS3 range, meaning that the lowest low of this third of the newest London session and the highest high of the highest London session incorporated 10 London sessions where we just went up and down and up and down. And half of London was in the premium and the other half of London was in the discount. 5 in the premium, 5 in the discount. Up and down and up and down and up and down until we began to expand from that. We didn't expand immediately. What we did is the London sessions got extremely close together, and then we broke out of that consolidation from that point. That's neither here nor there. So, what I found was is that if you take uh, just a regular fib, and this is what I call my premium discount fib. It's just 4 ranges that I stretched over, and I just added some little color to. I found that just like here, we often trade from London down to discount, up from discount to the premium. This level that's normally known as consequent encroachment, I call an intermission. And I call it intermission because the consequent encroachment is normally that 50% range. And this is breaking the range up into eighths, right? So I just call it an intermission between if you started from the bottom, you go like, number one, and then this is number eight. This is the intermission between number seven and number eight, right? But I often call it uh premium premium high of the LS3, right? Because this is premium discount. This is premium low. The gray area is premium low of this range, and the red area is the premium high of it. Then I will often refer to that level because if you can see it clearly, we this is yesterday's London session. This is today's, and on that graded range, we tap this level. Now, before this formed, we can go back and it was also tapping these same levels. I don't know. LS3, London session. That's why I say London session sets the tone. It's the anchor man. And I know I got that from ICT. There's so many videos I couldn't even tell you. So the price closes along this area here. Then we move up. We come back in. We almost touch. And we see this oftentimes before we're about to go through a level. If we get close to it, we pull back and then we go. And same thing you look at if you look at the weekly charts. And I said this before in another video. Look at the weekly charts, you'll see the exact same thing. When I say weekly, I mean if you look at the new week opening gaps or the new week gaps and the new day gaps, it does the same thing before it penetrates. And so we come down here, we form London session. Of course, the London session lows are right on that level. Today, the question that I'm asking myself is how can I better control shift S? All I'm doing is I'm adding this to my notes. Control V. I just added it to the notes. And what I wanted to see was what I wanted to remember is how price traded to this imbalance. That imbalance is right along that intermission level. It's in the discount low, right? Or premium discount high. It's in the low of discount low. This is actually a 16th. So what I found is it doesn't matter how low you continue to grade. Okay, now this is crazy. I'm gonna show you something. I'm gonna tell you something. ICT hasn't even told you for a long time because it's in some of his oldest material. Is that it doesn't really matter how small the grade gets. If I were to break this up into lower levels, price would still be divisible by those fractional components. And I think I know why. Why? Because I think let's the NASDAQ trade 0, 25, 50, 75, 0, right? That doesn't even matter right now. Why? Because I'm not doing math. I am measuring and grading London sessions, LS3, the three London sessions. Okay. Let's give you guys some of my internal thoughts. I'll just go ahead and post this stuff on the internet. And maybe you guys can call me a kook and an idiot or stop stealing ICT's material or whatever, whatever. But look here. If y'all ain't gonna learn it. So right. So we trade from this imbalance here, right at the intermission between discount low and discount high of, well, I guess we're in the discount, right? So you see what I'm saying? We're literally in the lower quarter. We're in discount low of LS3. Take that in half, and then we're operating in the lowest end, the lowest quarter of that level, but we're trading exactly to that zone. Then we displace. Now, it's extremely confusing when you look at it this way, but the reason that I use this like this is because visually I need to be able to see where price is closing and then where it's delivering to. Right now, I'm on the 15 minute. When I go down to the lower time frames, sometimes it's much more noisy. I'm watching this, I'm looking at these intermediate highs, right? Oh, its price going up. This is above this high, but it's not above that high. And I get bogged down in those lower time frame levels. So what I want to be able to do is at a glance, I just want to be able to look and say, oh, I see where we're closing. We're no longer we're in the discount. We moved the premium high of the next quarter, right? And that's what I mean in my videos when I say, oh, we've hit one standard deviation below, or no, we've hit half a standard deviation. We hit half a standard deviation below LS3, which means that once we get to -5, that's a half a standard deviation, right? Because the entire range is deviation. This is one full standard deviation. That's a half. So when we break low and we hit the half mark here at 18,738.25, we've just touched half a standard deviation. And then what do we see immediately once we get to that one half standard deviation away from LS3? And it happens like this every day. Well, there is some inconsistency. There is some inconsistency because if I am not looking at where we're delivering to, which is more important than LS3 standard deviation range, where is liquidity? If there is a higher time frame liquidity level here, which is um, a 0.75 standard deviations, that's where it's going to go. It's going to go for liquidity. It's not going to go for this measurement. This measurement is just a visual representation of just the landmarks that is passing on the way to liquidity, not to supersede order blocks, fair value gaps, and liquidity pools, right? But wait. But I'm gonna show you guys something ICT doesn't even know. So we trade back up into this level, which is just the high of that up close candle, which is something that I am really working on. Wicks and body closes, wicks and body closes, wicks and body closes, wicks and body closes. If the body closed here It's a high probability that the next wick is going to close here. Why? Because the close of this price here? No, because the lower that price is there. Body's not going to get there. The wick will get there. And that's something that boggles my mind because if I miss the initial move of a trade, I often would like, I know which direction the market is going. And I'm saying to myself, I would like to get on board this thing safely. What I'll often do is this candle, mistake, I'll often mistake this candle for this candle. Often mistake this candle for this candle. Meaning, I'll put my stop loss at the high of this up close candle, the high of this candle here. So that's where I put my stop loss. Price will move away, hit my stop loss, come back to my stop loss, and deliver. If that's ever happened to you, hit that like button. And you're saying to yourself, why did it hit my stop loss and deliver? That's why. Because you're saying to yourself, how many times have I put my entry in the wick and it never gets there? Why? Because you're mistaking this candle for that candle. These are two different stages of delivery. And that's something that you just have to work through. These are two different stages of delivery. This first initial stage, like this could possibly be considered a breakaway gap. We're on the 15 minute. But if the two wicks are pointing toward one another, I'm putting too much into a chart. But this is where I go on and on and on and on and on. And I'll do it again tomorrow until I get it right. Because one of the things that I'm more concerned about is that I get it right. Um, and I think that this is a pretty good review of what I'm seeing right now. The only thing that I could do now is I want to go to the higher time frame, 1 hour, 2 hour chart. And the thing that I see here is that there are nothing but down close candles all through this range. Then there's also this. There's also that gap. We rose and we touched that gap. I also see there's a long wick here, a long wick here, one wick here, and one wick here. And that bothers me. That bothers me. And the reason that it bothers me is because it reminds me of immediate rebalance, right? That price comes down to this level. This wick goes all the way up to that up close candle, touches its opening price, and then drops. Drops, comes down. This wick pops up. There's the price is in this range. The price is in this range. Price is in this range. Price is in this range. It's like a balanced price range. So he just immediately falls and then leaves this gap. Ah, hmm. So I'm very bad at predicting. I can't really forecast beyond the next 1 hour candle at best. I see price consolidating at this point. We've created two relative equal highs at the low of this gap. There's only 20 minutes left in this 2 hour candle, which means there's only 20 minutes left in this hour. There's an intermediate high. There's a small imbalance here. There's a possibility we could run consequent encroachment, maybe into the wick, maybe leaving an area here, maybe to the high. Maybe we hit the lower of that up close candle, and then maybe lower. But what else did we describe earlier? We described the possibility that maybe for the next 2 or 3 days or whatever, we would try to make our way back just a little bit higher, maybe into this imbalance here. But we closed that imbalance today, so maybe not. Maybe to the low of this wick, maybe just as high as the low of this wick. The only problem is that's kind of what I see here, as these wicks came up here. That the high of this wick, we stretch that back, that's into the low of these wicks. So there are a lot of things that I, me personally, don't see clearly. Um, and and I want to tell you guys that's the only thing ICT has on me. Is just his years of experience, his years of success, and his encyclopedia knowledge of the market. Just that's all he has on me. Um, yeah. So yeah. So the only other thing I like to do is just go to the 4 hour chart and just take a look and just take a look. And yeah, and this is basically all I'm seeing. 18 minutes left in the 4 hour chart. And we ran liquidity below the prior down close candle, just below a higher time frame gap. Hmm. And I left this candle or I left this gap highlighted this color because we could invert it. And I do know that there's a difference between inversion and inverted. And I can't even tell you. I'm really now. This is another video I want to make. The next video I want to make is, it's going to be very short. The next video I'm going to make is, um, understanding how to understand the ICT trading principles. And I know JCap has made a lot of good videos about this. A lot of other people, Casper and all these other people who've really broken down this information to a great degree. One of the things that I think that they have not said that I think that they should say is, when you learn what a up close candle is and a down close candle, you're gonna also learn that it's about 15 other things. There are about 15 other things associated with that candle that you're gonna learn, and you're gonna have to take it as slowly as that, and not uh, think anything more of it. If that makes any sense, and I know it makes no sense because everything is open, high, low, and close. Everything is open, high, low, and close, and that's the part that's been surprising me. And like we talked about today, that bearish order block was the wick of the prior candle. And it is not in the this is what I suggest. This is what I suggest. After you watch all my videos, and I in my catalog I have like 3 videos. And I know that ICT has hundreds or maybe thousands of videos. But if you go back and you watch ICT's videos, you go back to some of his oldest material. This is the stuff that he said that he's saying in his very first videos, and he's saying it so matter of factly that goes over your head. That, oh yeah, it's gonna trade up to the wick of this prior candle. And you're like saying, what? Yeah, about 50% of the wick of this prior candle. And you're saying, wow, what? Wow, what? Yeah. When you look at the higher time frame candles and you break them down, then you will see inside the wick period the PD arrays. That's where they are. Like, he says it's fractal. He's not. Problem with ICT is that he's not lying to you. Is that he's actually just telling you exactly what's there. And you still try, and I do the same thing too. I still try to figure out the difference between the three. Okay, I'm gonna stop this video, and I'm gonna post. I should probably chop this thing up. This is way too long. I should try. I don't know. I don't know. What do you think? Yeah, I think I will. I think I'm gonna chop this up, and I'll kind of just post it in pieces. It won't do anybody any good tonight. I'll just put it up because um when I become more accurate by doing this like this, when I become more accurate, then I want you guys to kind of be a part of that. Because I think anybody who trades is going to be extremely appreciative to their mentors and to the people who kind of came before them and showed them um, the ropes, right? And that's why, they say imitation is the greatest form of flattery. So I'm not, they won't be bearish order blocks. There'll be big bear order blocks. Um, I got some big bear order blocks, and I got some Red Bull. I can't say Red Bull. I think that's copyrighted. Um, Dead Bull. I got some Dead Bull. I got some Bull order blocks and what was the other thing? Yeah, that's why I recorded on the video. But then, man, I think this is gonna be fun. I think it's gonna be fun. Completely making up fictitious names for all of ICT's. Completely making up fictitious names for all of ICT's um concepts. in kind of in a really more of a spoofish way, but then in a more of a serious way, so that maybe 2 or 300 years down the line, people will be like, "Man, ICT and Grady were competitors. They were contemporaries." It's kind of how we do history, right? People just steal other people's stuff and appropriate it and keep rolling. Hey, whatever. That's not my goal. I just want to have fun and just show some appreciation to uh, you know, the guy. Peace.